Two topics I want to hit with you. I want to hit the economy and the Fed, but I think we need to start with the economy. After the great jobs report, a couple of things sink in. Growth in the labor force is a big plus, and a rise in employment to population and labor force participation rates, which means we're pulling in people we stopped counting. Can you talk about that and how the Fed may interpret those statistics?
No, absolutely. I mean, so first of all, the economy is great right now. And what we're getting that is not discussed very much is a very strong supply side response. And so over the last year, we've created about 2.7 million new jobs. But at the same time, 2.3 million new people have come into the labor force. And so about 85% of those new jobs have been covered by an increase in labor supply. And so that is allowing the economy to grow rapidly without putting a lot of pressure or creating imbalances that would make the Fed have to go faster than they already are going now.
And Mark, I can't stress enough, Ed Lazier and I discussed this. This is a huge variable, and at some point it might be a good buffer between some of the pressures of a labor force that we need and jobs that we're creating to keep it from turning into inflation and wage inflation. So now that it's the first day of a two-day Fed meeting, do you see any surprises on the horizon?
I don't think so. I mean, I think the Fed they look at a couple of things, the economy first, and that's very strong. Second is markets, and I think it's that in the end, markets will tell the Fed when they need to stop, and I don't think markets are signaling that at all. By far, the best predictor of the Fed's behavior is the spread between the Fed funds rate and the 10-year, and that's still at about a positive 100 basis points, implying they've still got room to keep hiking. The dollar is about the exact same level as it was on election night when Trump was elected, and so we're not getting a strong enough dollar to make the Fed signal that they have to stop. And also, when we had the sell-off last month, I think it was really interesting that we had high-yield debt was following equities, not leading equities. And that's usually a sign that it's a market correction and not an economic downturn. And so I think the Fed should be
that's a
pretty
huge
happy
point.
right now.
Yeah, that's a huge point, Mark. You know, the Barclay spreads on high yield and investment grade have been acting very well. Granted, it had volatility. You could see it in the ETFs like HYG. All right, real quickly, you know, disinflation, deflation is always the boogeyman of the Fed and always leads to maybe a Fed too nervous about future inflation. Just finish this up with some comments that you wrote about that were made by Paul Volcker regarding disinflation and the financial system when it's under stress.
Yeah, no, absolutely. I mean, so Paul Volcker made probably the most important comments on central banking in a long time, where he said that most central bankers today do not understand that deflation comes from one thing, and that is when the financial sector is collapsing, and that comes from allowing imbalances, boom-bust cycles to start in the first place.